Traders, I need you to listen very carefully right now because you are sitting in the middle of a compression that is one news headline away from detonating. While most of the market is asleep, euro to US dollar is coiling into the tightest range we've seen in weeks, and there is a trapdoor right underneath the price that is about to spring shut or open the floodgates. There is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end because I'm giving out 3 exact entry and exit levels you can use now, complete with stop-loss placement and risk-reward logic. This is not a guess, this is institutional workflow applied directly to your screen. Here is the instant market verdict for euro to US dollar on this session. The bias is bearish, range-bound compression fading towards the key support floor. We are trending lower on every meaningful time frame, but we are not crashing. We are creeping, grinding, dripping lower into a zone that is absolutely loaded with liquidity. The one invalidation level that proves me wrong right now, write this number down. If we break and hold above 1.1680 on a daily closing basis, the bearish structure collapses and we flip to a broad sideways play, potentially targeting 1.1750. But until that happens, the weight is down, and the trap is set at 1.1590. So write that number down. 1.1590 is the fuse. If that goes, the whole floor gives way. Now let me walk you through exactly what the chart is screaming at us right now, from the top. Timeframes all the way down to the 60-minute execution chart. Start with the weekly picture. Weekly trend is a sell signal, meaning the sequence of lower weekly closes remains intact. The last meaningful bounce failed ahead of the 50-week moving average, and that failure is now casting a long bearish shadow. On the daily chart, we are in a strong sell structure. Price is trading comfortably below the 20-day moving average, which sits at 1.1664, and also below the 50-day and 100-day moving averages at 1.1681 and 1.1679 respectively. This is not a messy sideways chop. This is a clean bearish alignment where shorter-term averages are rolling over and acting as dynamic resistance above us. The daily MACD is negative at minus 0.001, no bullish divergence, just steady selling pressure with very little energy for a counter-trend rally. The RSI on the daily is at 44 and falling, not yet oversold, which tells you there is still room to the downside before we reach exhaustion. This is the kind of setup where stops above 1.1680 become a magnet, and the path of least resistance remains lower as long as that ceiling holds. Now drop down to the 4-hour chart. Here's where the compression becomes unmistakable. We have a series of lower highs and a flat support floor around 1.1603, with the 200-period moving average on the 4-hour resting at 1.1590. That 200-period average is acting like a brick wall right now, or more accurately, like a razor-sharp knife edge. Price has tested it, bounced a handful of pips, and then crawled back down to hug it. The 4-hour MACD is flat, showing a total lack of momentum either way. This is the classic sign of a market coiling up energy. On the 60-minute chart, we are even tighter. The 20-period moving average on the hourly is at 1.1633, price is currently at 1.1631, so we are essentially pinned right under it. The 60-minute trend is a strong sell, and every tiny bounce towards the 1.1650 mini resistance zone gets sold into instantly. What you're seeing is a market that wants to break but doesn't yet have the macro excuse. Support levels to tattoo on your brain. 1.1603 is the immediate floor, and 1.1590 is the line in the sand, the daily 200-day moving average. Resistance levels. 1.1650 is the first ceiling, and 1.1663 is the secondary ceiling where sellers reload. The space between 1.1603 and 1.1590 is the most dangerous pocket in the Forex market today. If that pocket gets filled, it's not a dip to buy. It's a trap that could snap into a full-on collapse. Here's what most traders miss when looking at this compression. They only see the horizontal levels, but they're not reading the cross-asset language that's predicting the move. Right now, the dollar is turning marginally higher, and the catalyst is sitting in the geopolitical arena. The 24-hour news flow is dominated by uncertainty clouding the U.S. Iran peace talks. That uncertainty is pushing a safe haven bid into the dollar. It's not a huge risk-off wave yet, but it's enough to cap every euro rally and keep the greenback supported against the entire complex. This is the dollar killer fracture playing out in slow motion. The euro itself has no real domestic story today. The ECB remains on hold, cautious, and frankly boring. Meanwhile, across the channel, the Bank of England is sounding more hawkish, which is why if you pull up a pound sterling to US dollar chart right now, it's holding up far better than the euro. That relative weakness is the institutional tell. Fund flows are rotating out of the euro and into sterling on the crosses, and that same dynamic is bleeding over into euro to US dollar, making the euro the weakest antagonist against a dollar that just needs a reason to strengthen. When you layer on the macro clarity vacuum, no major EU data, everyone waiting for the next US durable goods print and any Iran headline, you get exactly this compression. The 1 to 2 week directional lean is this: as long as the US Iran tension keeps a bid under the dollar and ECB stays dovish by omission, the path of least resistance is a breakdown through 1.1590. The exact event that would invalidate this thesis is a confirmed positive outcome from the peace talks that triggers a risk-on flush and dollar sell-off, pushing euro to US dollar back above that 1.1680 death zone. If we close above that on a daily candle, the bearish case is temporarily dead. Until then, assume every bounce is a gift to sellers. Now we get to the part of the video most people will skip, but this is where money is made. Keep watching. I'm going to hand you 3 precise strategies, each with a trigger, a stop, and targets. No theory, just a plan you can execute. Strategy 1, the sniper, for the conservative trader who wants high probability and is willing to wait for the market to confirm its hand. The trigger condition is a decisive 4-hour candle close below the 1.1590 level, and ideally a retest of that broken support as new resistance. So after the break, you wait for price to come back up and kiss the 1.1590 zone from below, failing to reclaim it. That is your entry. Your stop loss goes at 1.1620, just above the failed support turned resistance and above the prior minor swing low. The logic is simple. If the market reverses back above 1.1620 after a breakdown, the breakout is false and you don't want to be short. Your first target is 1.1550, giving you a risk reward of roughly 1 to 2 on that leg alone. The second target sits at 1.1500, extending the RR to around 1 to 4. The one thing that voids this setup is a sharp V-shaped recovery that closes back above 1.1620 without any hesitation, because that would signal a liquidity grab, not a genuine breakdown. Strategy 2, the active trader, for the standard trader who wants to ride the intraday momentum without waiting for the huge break. This is a trend continuation play. Your entry condition is a pullback to the 1.1650 resistance zone, which aligns with the 20-hour moving average and the top of the immediate compression. You wait for a bearish rejection candle on the 15-minute chart, a pin bar or a bearish engulfing, right at that level, and then you enter short on the next candle's open. Stop loss placement is logical. It goes at 1.1682, just above the cluster of moving averages and above the key structural invalidation point we discussed earlier. That gives the trade enough room to breathe above the noise without letting the bearish structure break. Your first target is 1.1603, the immediate support. That alone offers roughly a 2 to 1 risk reward depending on exact entry. Once target 1 is hit, move your stop to break even and let the runner ride to 1.1590. If we see a decisive break of 1.1590 on the way down, trail the stop above the hourly 20-period moving average and hold for a further extension towards 1.1550. The beauty of this setup is you're trading with the dominant trend, entering at a premium price, and using a clear structural invalidation level. Let's see how aligned we are right now. Type your euro to US dollar range for tomorrow in the comments. I'm reading them. Put your high and low estimates down, and let's see who's got the market dialed in. I'll call out a few of the best ones in tomorrow's video. Strategy 3, the aggressor. This is for those who know how to lose small and manage risk aggressively. This is a high-risk counter-trend bounce play off the 1.1590 floor. The Idea is that the market may fake a breakdown, run stops below 1.1590, and then snap back up violently, trapping late shorts. If you understand liquidity engineering, you'll know that the 200-day moving average is a prime hunting ground for stop runs. So here's the plan. You wait for a spike below 1.1590 that immediately reverses and prints a bullish engulfing candle on the 15-minute chart. Entry is on the close of that engulfing candle, or on a break of its high. Your stop loss is extremely tight, 1.1580, just below the spike low. If the market doesn't bounce instantly, you're out with a tiny loss. The first target is 1.1640, which is a quick scalp back into the prior range, offering more than 3-to-1 risk-reward on a tight stop. The second target is 1.1660 if momentum explodes. This is not a trade for the faint-hearted, and I want you to repeat after me. I will only take this if I accept that a 10-pip stop might get hit, and I will not revenge trade. Only for those who understand asymmetric risk. Before I wrap the trade section, this is non-negotiable. Never risk more than 1 to 2% of your account on any single trade. No positions held through high-impact news like U.S. durable goods or any surprise Iran headlines. Stops are not suggestions. They are your only insurance against a leverage wipeout. Risk management is the difference between a trader who survives a decade and one who blows up in a week. Now let's close the loop and set you up for tomorrow. The single most critical level for the next session is 1.1590. That is the pivot on which everything turns. If it holds and we get a confirmed reversal candle, expect a violent short covering rally back towards 1.1680. If it breaks with conviction, the downside accelerates, and I'll be targeting 1.1500 in a matter of days. Tomorrow we have the U.S. durable goods orders hitting the tape, and any further headlines from the U.S. Iran peace negotiations could act as the spark. The compression is unsustainable. It will break, and you now have a plan for whichever direction it chooses to. If you want the full breakdown on Bitcoin and the S&P 500 divergence, that video is live now. Check the end screen, because the correlation fracture I'm seeing there is going to surprise a lot of risk asset traders. Smash the like button if this analysis gave you a clear, executable plan for your session. Subscribe and hit the bell to get daily coverage of 8 key assets before the market moves. I'll see you in the next one, right here on Alpha Market Meridian. Stay sharp.